Okay, this is Brian Stoll for Timing Strategies, Friday, March the 7th. And if you want to read the article, it goes into a little description on what we're shooting for over the last couple of weeks. God, it's been a long, miserable week. But our first target here, you can go to the article archives and you can see our article, Stock Market Choke Points, Part 4A, and that's followed sequentially previously by Part 4, 3, 2, and 1. Well, we've been short ever since this point right here, which is February the 2nd or 3rd about. I don't know exactly what day that was, but after a retest at highs, yeah, February 2nd, we were short. We've been short 50% this whole way. Our target so far has been hit, which is right here for B1. We are now long 50% at this point. And if we get a trade that goes below, I'm going to do this here. If we get a trade that goes below this level of our entry point on our buy day, which is basically the close of 129, anything that closes below 129, let me back this out. Anything that closes below the lows of today's low, yesterday's low, which is going to be yesterday's on Monday, we will at least go flat, if not short back again, looking for B1 or B2 target B2, which is down here at 123.78 on the spiders. Works out to be, 1235, 1230 on the S&P cash. A lot of people are looking for that level also, so obviously this is not the most singularly original idea. I've got my price targets using my methods. Other people use theirs as well differently. But bottom line, we're long here. Our risk management dictates a close below that level. As long as it's not a huge close below that level, we may or may not go flat or short again. That's a matter of discretion in our systems, our signals. Basically, we have a pressure system, a stress metric that determines whether we're going to get long or short at 1230 or not, or go flat. But again, we are long by 50% as of Friday's close. Go into some real quick other symbols. The GDX, everybody's talking about gold and inflation. My friend, this is something that you have to look at in context to the overall market that could, be mild deflation. Ultimately, it's probably going to result in hyperinflation, but we got a box here, basically a box top is what I try to call it. And, you can call it a gap island top or whatever you want to use. But all we need, terminology-wise, is an open on the GDX that opens below this level, anywhere below Friday's close level, and then trades lower and closes below the threshold of the 3rd or the 4th of February. Anything that closes below there. And we got a major island reversal, gap island reversal. I call it a box top. Or we, down here in the February area, here's a box bottom. It's a range that gaps out of the range and never comes back. So if that's the case, then that signals a lot of pressure off, the inflationary signal. Real quick, take a look at soybeans. H8. I mean, massive drop in the last 1, 2, 3, 4, 5 days. We actually, for my own personal account and just a couple of high risk aggressive clients, we've got some put options. We've had the put options since there, so we've kind of been sweating it. They're the July 1100 call options. But what that's going to translate to is, and if you look at wheat, WH8, get rid of all that stuff. Let me just stick with the beans. The wheat's getting real volatile. It's starting to come down here. Looks like it's starting to deflate also, but I don't want to lose my line, so I'm not going to change it. The soybeans are really starting to come off, and anytime you can get a short entry on any kind of a retrace back up into that range might not be a bad plan on a low risk, small position. What that's going to translate to in stock terms is if you look at the XLB. XLB is just starting to come off its top. Massive close on its lows yesterday should lead to further downside momentum if we get a gap and a move in a trade that gets us back up into the range of yesterday, anywhere in that range, based on the next 1 or 2 days. we absolutely will be looking to get short the XLB again using this SMN, which is a inverse 2 beta ETF of the XLB with the material sector. Also translating into what that's going to look like in the XLE. Oil services starting to come off their highs, and in that scenario, you look at the OIH also. OIH, I mean, it's still strong. It's kind of the refiners and the bigger ones like the Exxons. Not as fast moving as the XLE, but it also looks like the weakness is starting to break that regression line, that channel that you want to call, basically that has maintained it on the way up. And it's been a very tight range, is now broke. So that could lead to a lot of selling in the commodity-based and material-based sectors. And ironically, what will that translate into short-term is a pop in the XLF. And I got so much junk here, I don't want to get rid of all of it, but let me just get rid of some of the noise here. The XLF has basically taken out the lows of the January 21st level, spiked it, and now we're trading back above there. That could be a very interesting position of, if you want to do a spread, getting long the financials, short the materials and the oil. That's very risky, but risk is equivalent to the reward. We could see, on a percentage basis, we could see a 15-20% bounce or higher, at least back up to that 28 price tag, which would be 20% almost from here, which is nothing to consider considering the move that we've seen on the way down. Yeah, 15% move back up to the $28 price tag on the XLF. So, we could see a reversion or a regression, alternation of assets from materials to paper, and then eventually it's going to go from paper back to materials and stuff. But in the meantime, like I said, our SPY, we're long, looking for a bounce. The bounce, depending on what we get, could carry us back up into that range of about the 137. I mean, it's a day-by-day thing. Doesn't mean that's what's going to happen. We could very easily get another shakeout. This could be a 2002 scenario where the market just pops up 1 or 2 days and then bam, slams back down again. So we're going to take it day by day. We'll see what kind of price action we get tomorrow going into the first couple of days of the second week of March, and an options expiration. We got the Fed meeting and all that we all know about. But this is a day-by-day long position. Longer term, I'm bearish, but there could be some very violent rallies in the shorter term, and that violent rally could easily take us back up into that kill zone where we're really looking to get short heavy at 1420 all the way up to 1500 on the S&P. I doubt we'll ever see 1500 again, but 1420, mid 1400, 1440 range, very easy, and that would put on a huge short position at that point. But we'll keep you posted day by day. Hopefully this video works through YouTube, and if you have any questions, please give us a call or an email. Wish you all the best, and have a good evening. Oh, set your clock forward, spring forward 1 hour.